This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Tuesday, August 11, 2026, and this is the New York session. Now, let's get into it.
We are looking at a classic distribution pattern right now. The S&P 500 tracking via SPY is consolidating at the apex of its 10-day range. We are sitting at 773.3, which is merely $3.82 below the high of 776.85. Meanwhile, the Nasdaq QQQ has broken below the previous session's open at 722.39 and is currently at 720.87. That is a clear short-term momentum loss. And underneath it all, the Russell 2000 IWM is probing critical support at 299.98, dangerously close to the 5-day low of 297.22.
And that proximity to 297.22 is where the danger lies. The VIX is stuck at 14.9, comfortably inside the lower bound of its recent range. That is a volatility trap. The market is pricing instability while the small-cap complex shows early signs of capitulation. You cannot assess broad market health solely through large-cap indices when the IWM is testing its floor, and the VIX is too low to provide any cushion against a sudden liquidity shock.
It is not just a technical breakdown, it is a structural rotation. The data confirms we are seeing capital flee rate-sensitive growth sectors like technology and real estate in favor of hard assets. Energy, represented by the energy sector, is surging 4.66% to 60.18, while the technology sector, is declining 0.88% to 186.32. This isn't random noise. It is a deliberate hedging against the 10-year yield sitting at 4.65%, and the flattening yield curve.
That rotation is the defining feature of this session. As CIPHER noted, energy and healthcare are absorbing capital while the broader index, SPY at 773.3, consolidates with diminishing momentum. We are seeing a violent bifurcation where hard assets are bid, but the mid to small cap complex is facing a liquidity vacuum. IWM is hovering near 297.22. And if that breaks, the divergence between the safe havens and the speculative quarters will force rapid deleveraging.
Let's zoom in on that pressure point. Grid, walk us through the technical structure of the Russell 2000. What happens if that 297.22 level gives way?
The vulnerability is stark. IWM is closed at 299.98, which puts it only $2.76 above the critical 5-day low of 297.22. A breach here exposes the 10-day low of 287.83. That represents a downside risk of roughly 4% in the small-cap complex. We are essentially staring down the barrel of a mean reversion move toward the center of the range unless 297.22 holds firmly as support.
Which brings us back to the VIX at 14.9. The current structure exhibits a classic volatility trap. The SIBO volatility index is well within the lower bound of its 5-day range, which historically precedes expansion events. But here, it is ignoring the structural deterioration. The 10-year yield is at 4.65% against a 2-year yield of 4.19%. That critically flat spread is pressuring rate and utilities. When IWM breaks 297.22, the low VIX won't protect anyone. It will just mean the move down is faster and less hedged.
Exactly, and look at the earnings catalyst validation in the background. While IWM struggles, we see specific names like LSCC gaining 4.8% to 134.43 on positive earnings, and FSLR up 3.5% to 247.82 on analyst upgrades. Conversely, ANAN has gapped down 18% to 31.8, and EVC dropped 16.1% to 9.81. The market is punishing weak fundamentals severely. The energy lead CIPHER mentioned earlier is supported by this flow data. Capital is moving into established, cash-generative names and away from speculative, high-duration assets.
So the takeaway is clear. The SPY stability is hollow. As CIPHER pointed out regarding LSCC and FSLR, strength is isolated to specific, fundamentally sound names within energy and semiconductors, while the broader beta, IWM and the technology sector, is softening. We need to monitor whether SPY can reclaim 775 plus with volume, or if the 297.22 break triggers a cascade.
Let's shift to the leader of the pack today, energy. The energy sector is up nearly 5%. Grid, is this a sustainable breakout or a final exhaustion's pump?
The energy sector is at 60.18, leading all sectors with a 4.66% move. Technically, this is a relative strength play amidst broader weakness. However, we have to look at the sector rotation. The energy sector is decoupling from the broader index stagnation. The question is whether this is genuine demand or simply funds fleeing the technology sector, which is down 0.88%. Given that the technology sector is also struggling to hold its own momentum, the energy sector is benefiting from a flight to safety within commodity cycles. There is no immediate resistance signal on the energy sector intraday chart yet, but the divergence from the SPY 776.85 ceiling suggests the broader market isn't participating in this rally.
It is definitely a flight to safety, but driven by macro headwinds. Real GDP growth is stalled at 1.5% annualized, and non-farm payrolls show a contraction of minus 23,000. This stagflationary mix favors energy and healthcare over speculative tech. The 10-year yield at 4.65% makes utility-heavy portfolios unattractive compared to the cash flow visibility of energy constituents. So yes, the energy sector is up, but it's up because the rest of the economy is contracting.
And let's not ignore the microcap bloodbath happening in parallel. FNGA is down 95.1% to 21.28. Sion is down 91.18% to 4.5. And Tanks is down 89.77% to 1.38. These are catastrophic failures. While the energy sector looks strong, the underlying liquidity conditions are deteriorating rapidly. The fact that we have 3 tickers losing 90% of their value simultaneously suggests that leverage is being unwound across the board. The energy sector's rise is partly a mirror image of this forced liquidation elsewhere.
Precisely. The energy sector surge is a defensive hedge against rising yields and stagflation, not evidence of healthy bull market participation. As Grid noted, its relative strength, but SPECTER point about the microcap failures highlights the fragility. Capital is piling into energy because it has to. It's one of the few places left with yield visibility. But the volume in those microcap failures indicates a total collapse in speculative valuation models. We are seeing a bifurcation. Hard assets up, speculative assets down.
Now let's look at the technology complex. The technology sector is down 0.88% to 186.32, despite a positive weekly gain of 4.65%. Is this a healthy pullback or the start of a deeper correction?
Technically, QQQ at 720.87 has broken below the previous session's open of 722.39. That is a bearish cross. QQQ is trading in the lower half of its 10-day range of 661.14 to 728.54. Being 1.1% below the high of 728.54 confirms short-term momentum loss. If the technology sector fails to hold support, we could see further erosion into the 710 area. Currently, it is holding just above the midpoint of that range, but the breakdown below the prior day's open is the first red flag.
The sentiment doesn't support a bounce yet. While MSFT has a positive sentiment score of 0.5 and NVDA is at 0.36, the broader tech index is bleeding. The sector ETF, the technology sector, is down 0.88%. Individual megacap sentiment is not enough to offset the daily decline in the broader tech index. This suggests exhaustion in the AI and growth trade despite favorable headlines. The crowd is taking profits, and the low VIX means there aren't many puts being bought to defend this level, leaving it naked to further selling.
It's profit-taking at resistance levels. The plus 4.65% weekly gain in the technology sector has brought it into contact with major resistance. Combined with the 0.88% daily drop, we are seeing acute profit-taking. Furthermore, the negative earnings sentiment in names like ANAN and EVC reinforces that investors are wary of multiples. They are selling tech to buy energy. It's a portfolio rebalancing. Not necessarily a crash, but a shift in preference from growth to value/cash flow.
I'd caution against calling it a healthy pullback. With the VIX at 14.9, there is no fear premium in the options market to cushion a tech sell-off. Usually, when tech corrects, you see a spike in VIX as hedges kick in. Here, the VIX is flat. That means if the technology sector breaks below key support, the move could be sharp because nobody is positioned for it. The disconnect between the low VIX and the breaking of QQQ below its prior open is a warning sign.
So we have Grid identifying the technical break below 722.39, CIPHER noting the profit-taking after a strong week, and Pulse pointing out that sentiment hasn't turned bearish enough to justify a start-buying rally. The consensus is that the technology sector is vulnerable until it can reclaim momentum. Without a new catalyst, the path of least resistance is sideways to lower, especially with the broader market split between energy strength and tech weakness.
Let's touch on the volatility regime. SPECTER, you've been flagging the VIX at 14.9 as a trap. Why is that level concerning right now?
Because 14.9 is near the bottom of the 5-day range of 14.77 to 18.43. Low implied volatility often precedes expansion events. We have a flat yield curve at 0.47 percentage points, sticky CPI at 3.46%, and slowing GDP. The market is calm, but the fundamentals are stressed. When the IWM breaks 297.22, or if SPY rejects at 776.85, that calm will vanish quickly. We are seeing no protection in the options market. The calm before the storm is ending because the storm is already building in the small caps and rate-sensitive sectors.
And technically, that low VIX allows for a wider swing range. If we get a move, it won't be a slow grind, it'll be a gap. SPY is already at 773.3, so a break below support could see it slip quickly toward the 760s. Similarly, QQQ breaking 720 could accelerate fast. The low volatility environment removes the friction that usually slows down trends. Once the direction is chosen, likely lower given the IWM pressure, the move will be swift.
Agreed, the liquidity is thinning out in the smaller names. The micro-cap failures, FNGA, Cian, Tanks, are absorbing volume and reducing available float in the broader ecosystem. This amplifies the impact of any negative news. The efficiency of the market is dropping. It takes less volume to push prices around because the depth is gone.
Synthesizing this, Grid sees the technical fragility at key support levels, 297.22 for IWM, 722.39 for QQQ. CIPHER identifies the fundamental driver, rotation to hard assets due to stagflation fears. SPECTER warns that the VIX at 14.9 offers no cushion, meaning any break will be volatile. Pulse notes that sentiment is exhausted. The setup is hostile for long exposure in the technology sector and IWM. Risk favors staying defensive or hedging until SPY clears 776.85 or IWM stabilizes.
Final thoughts on the session. What are the key levels to watch when the bell rings?
Watch SPY at 776.85. If it rejects, expect a move lower. Watch IWM at 297.22. If it breaks, expect accelerated selling. Those are the two binary outcomes for the session.
Watch the divergence. If the energy sector continues to outperform while the technology sector and IWM weaken, the rotation is confirmed. Look for earnings plays like LSCC or FSLR that have actual fundamentals supporting them, rather than chasing the broad index.
Keep an eye on the VIX. If it ticks above 15.5, the complacency is officially over, and traders will rush for cover. Until then, don't trust the quiet.
The risk is asymmetric. Upside is capped by the SPY ceiling and yield pressure. Downside is open if IWM breaks, Position accordingly. Don't fight the trend in the small caps.
To summarize, the market is bifurcated. Energy and healthcare are strong due to macro headwinds, yields, inflation. Technology and small caps are under pressure due to technical breakdowns and earnings scrutiny. The low VIX suggests we are ripe for a volatility expansion if support levels fail. Stay disciplined.
That wraps up our pre-market analysis for Tuesday, August 11, 2026. Key takeaways. SPY is testing resistance at 776.85, IWM is threatening support at 297.22, and the market is rotating heavily into energy and healthcare. Tomorrow, watch for confirmation of the SPY breakout or rejection, and whether IWM can hold the line at 297.22 to avoid a broader breakdown. Thank you for joining the ShadowQuant Equities edition. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the after-hours session where we will see how these calls play out. Until then, trade safe.